So once again, I welcome you all to today's section. In today's section, we are going to practice consolidation. A full question on consolidation, both consolidated statement of financial position and then a consolidated statement of comprehensive income. So that is the question that we are going to practice today on consolidation. Basically, the basis has been treated in the previous videos. So if you have not gone through that, kindly do that for us before watching this. So go through the basis with us. So now, when you start with the consolidation, there are three financial statements at the financial reporting level that they will ask us to consolidate. Consolidate, as you already know, bringing the parent financial statements to that of the subsidiary, adding the two together, or prepare just one financial statement to present the entire group. Now, the basic principles in a consolidation, I'll summarize them before answering this question. That will provide a gentle reminder. But still, the detailed principle or the details concepts in consolidation has been dealt with in the previous sections or the videos. So let's capitalize on that. To start with, what are the financial statements that we can prepare consolidation or we can consolidate? The financial statements, they are, so one, we can consolidate the comprehensive income. Each and every one have its own methods. So comprehensive income prepared by the parents and then the subsidiaries, we can consolidate it. Number two, we can prepare what we call consolidated changes in equity. So changes in equity, we can consolidate that one too. So changes in equity. So you can prepare consolidated statement of changes in equity. In fact, good. Number three, almighty. Statement of financial position. Financial position. Powerful. Financial position. So these are the three common ones. Number four, we can also consolidate cash flow, but this is in the advanced level. That's corporate reporting or strategic business reporting. So in the SBR paper, that is where we prepare cash flow or consolidated statement of cash flow for the group. Or in corporate reporting. But for the financial reporting level, your consolidation is centered on this and this. So you must know how to prepare a consolidated comprehensive income and then consolidated statement of financial position. So brief, I walk you through the financial position. That is the one that comes with a lot of principles, basic steps, first step, second step, and what you need to know about them. So let's see the basic principle behind, and then the workings that you need to prepare for us. There are some sections, or some of these workings can be added up. So let's see. Now, to prepare financial position, that is the statement of financial position, to consolidate. Parent to prepare and subsidiary to also prepare. We are just adding the two financial statements together. The following principles need to be taken care of. So number one, your very first step in financial position is about the group structure. The group structure. That is the percentage holding, parent percentage was holding in the subsidiary. Don't forget that one, bring it here. So if the parent have 60%, oh, just write the parent name here. Parent name should be here. Write a subsidiary name here. And then the percentage holding, maybe parent owes 75% of the subsidiary. Then what about the non-controlling interest, NCI? The other percentage held by the other people is also 25%. When I put all of them together, I'll get 100. That is how the group structure will look like. In event where we have an associate, good. Let me draw some little principle again. Now, anytime you have 0 up to 19, 0 to 19, we call it a mere investment. So write it down. We call this one accounting boundary. When you finish financial reporting and move on to corporate reporting at the final level or strategic business reporting, you always need the accounting boundary. Very important, because over there, we'll be moving you between control structures or investment. So 0 to 19, a mere investment. So this is a mere investment. Mere investment. We use IFRS 9, financial instrument, to account for this. Financial instrument, IFRS 9, to account for this. What if I have 20 up to, from 20, in fact, from 20 up to 49. 20 to what? 49. We call this one a significant influence. Significant influence, and give up to associate. So you have what you call significant influence. We call it associate. If I have 50, exactly 50, we call it joint arrangement or joint venture. And then the standards that we can use is IAS. Over here, this is IAS 28. Associate, investment in associate. Investment in associate. If I have 50, we call it joint arrangement or joint venture. So joint venture or joint operations. That one is IFRS 11. So IFRS 11, control joint venture. Then I have from more than 50, between 50 and what? 100. We now call it control. And that is subsidiary. At financial reporting level, we only treat this control and associate. We've done IFRS 9 already, so we've gone through how to account for equity investment or financial assets. So that's all. So this is we call this accounting boundary in group structure. I'm done with this. So let's go. Now, today's question we're about to solve, you cannot afford to mix the principles. So right from the group structure, you can also put it in the form of diagram, the alternative presentation. Parent name will come here and do like this. Parent have acquired maybe subsidiary 75%. So NCI will be 25%. That's all. We're done. So you can represent it in a nice diagram. Effective date of control, we'll put all of them in. Now, the group structure to the workings. We have group structure B, then effective date of control or date of acquisition. Effective date of what? Either control or acquisition. Kindly tell us exactly when or exactly the exact date the parent gained control over the subsidiary. Tell us the exact date the parent gained control. And then the B, the C talks about the period of consolidation. Period of what? Consolidation. Are you doing the consolidation for a full year or just for a 6-month period or 9 months or more than a year? Tell us. So that's the first workings. And then I'm going to workings number 2. However, there are diverse methods with the workings. These workings have adopted one of the professional bodies, that is the Institute of Chartered Accountants, Ghana, approach. So in the subsequent questions, I will come to ACCA method, or the one that is widely used by the ACCA. So today, let's use ICA Ghana method. Yes. Good. Now, let's go to the next one. Step number 2. Kindly tell us the cost of control or cost of what? Consideration. So cost of control. Cost of what? Control. Or cost of consideration. Cost of control or cost of what? Consideration. Over here, what goes to consideration? Consideration or cost of control means the fair value of cash and cash equivalent, or cash and cash equivalent, and the fair value of other consideration transferred to acquire the subsidiary. So in short, the total cost that the parent incur in the acquisition of the subsidiary. That's what we mean by what? Cost of control. Basically, it's made up of the following: cash. You can pay cash. 2, you can also pay with shares. We call it share exchange. Share exchange. Or you can call it share for share. Now, if you can buy a share and pay with a share, then you can also buy a share and pay with a vehicle. So you can transfer assets. So take note, most of the questions, most of the exam questions. Now, I call this benefit in kind. You can pay in kind using any other asset to pay. So you can use any of your assets to pay for these shares. Just the most exam question use what? Shares. So you are using shares exchange, share exchange. So take note of it. So it can also be PPE exchange. So I am exchanging PPE for the shares that I've acquired. So when I give the owners PPE, I'm done. Now I need to settle the owners, the subsidiary, the owners. I need to settle them before I can acquire the shares. So whatever I will use to settle them, that's the consideration. That's my cost of control. How much it costs me to obtain. Maybe even if I should not operate for 5 years, and that is what they will accept to surrender the shares to me, that's my cost of control. Powerful. Let's go. Then we can also have what we call deferred consideration. Deferred consideration. When we say deferred consideration, we are saying that sometimes you may defer some of the payments into the future period. So look at how we treat this. Then you can also have what you call contingent consideration. Contingent consideration. Contingent consideration, meaning that here the consideration is upon what? Condition. 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 So I will pay you extra 50 cedis if your profit after tax is more than mine. That's all. If you can do this, I'll give you extra money. So that is a contingent consideration. That consideration is dependent on what? A particular condition or a clause. There'll be some clause that tells or that comes with additional consideration. So let's take note. That is all. You can also pay with a loan. Yes, a loan or a debt, like the question we're about to look at for. The question that we are about to solve. You pay with what? A loan. So see how we'll solve that particular question when you pay with a loan. Good. So that is it. We can pay with what? A loan. So let's see how we do that. So we are done with the cost of control. If it has been given to you, why not? The third exam not given, then you move on. So if you add all this, you get your cost of control. So we just pick question, then move on. Workings number 3. You need the net asset of the subsidiary. Net asset. So the net assets of the subsidiary. So here you start by telling us the format, everything in there. At acquisition, at what? Reporting, and then post acquisition. What goes in net asset? Your share capital or stated capital. So much, and just sometimes dash. Most often is dash. The reason being that upon acquisition or after acquisition, the subsidiary have not raised any additional shares. That is why. But when you move on to strategic business reporting or corporate reporting, we can change that story to a different bit. So this is the stated capital. In fact, the net asset is just the equity section on the balance sheet. It represents the equity. So all the equity items, list them. Retained earnings, other reserves, or capital surplus, all of them. Plus fair value adjustments. Unrealized profits, if the subsidiary is the seller. And then more item goes in there. So that's how we prepare the net assets. Summary. Please, the detailed notes and the detailed principle and detailed explanation has been dealt with in the previous videos, which has been posted on the platform. If you don't have it, kindly draw our attention. We'll make it available to you. Let's go. Number 4 is your goodwill. Computation of goodwill. Computation of goodwill. Computation of goodwill. Now, let me explain this. Some of the ACCA computation, we combine this as workings number 2, all these 3 as workings number 2. So 1, 2, 3 are fused together in just one heading. But for ICA Ghana, some of our computation, we break them down like this. Good. So that is, in fact, we can do any of them so long as you don't deviate from the main principle. You are correct. The presentation is not all that important, but make sure that you don't deviate from the principle, the underlying way. So if someone will say, okay, me 30 plus 40 minus 20 is equal to 50, then somebody can also say that, okay, then negative 20 plus 30 plus 40 is also equal to the same 20. Or the same 50. Have you seen how they have arranged it? Basically, it does not change the final answer or the principle behind it. You are subtracting this, it's enough. Over here, you are subtracting it, it's okay. But why are you going to make it positive instead of negative? That's where we will not understand. So let's take notes of it. Goodwill, there are 2 types or 2 ways of valuing the Ncdi. So it's called for 2 different goodwill computation. So we can have the fair value method or full goodwill method. Then number 2, we have the proportionate interest method, not half. Proportionate interest method. All of these has been dealt with, and that's a goodwill. Now let's go to number 5. So proportionate interest method, and then the fair value or the full goodwill computation. Now you go to number 5. Call it group retained earnings. Group retained earnings or group reserve. Number 6, NCI at reporting. Normally, I put into bracket financial position. NCI at what? At reporting. Why do I put financial position there? Meaning that if you go to financial position, because there's a particular NCI that goes to P&L and there's one that goes to financial position. Number 7. Number 7 is investment in associates, if there's associates in the question. Investment in associates. That's number 7. Investments in associates. Or these are the major ones. There are other ones that one we cannot mention all of them here, such as intra-group adjustments. Yes, elimination of intra-group sales and intra-group purchases. All those ones, they are in there. Good. P&L normally don't come out with a lot of workings, but instead we also have few ones that goes in there. So when I start, you'll be fine. So we are done with a summary of the financial position workings that you need. Now for the comprehensive income, that one you still need the group structure, but you don't need all this. No, you don't need it. So this is not for comprehensive income. So comprehensive income, you still need a group structure and you still need NCI, but just that the NCI that you need is NCI at reporting. That will go to profit or loss. And that is all. We are done. So you are going to pick our very first question. Very fantastic one, of course. So pick that question and then we'll do justice to that one. Okay, so let's see the game. Let's see that particular question. Good. Okay, let's see. Okay, so let's go to this particular question. Okay, so this is Sanford and Premier. That is the question, Premier. So let's go to the comment. Okay, so let's look at this particular question. Going straight to the requirements. Prepare consolidated statement of comprehensive income for the year ended 30th September 2010. And prepare consolidated statement of financial position for Premier Assets 30th September 2010. That is December ACCA 2010 financial reporting question. So let's see. Okay. Right after the requirements, you set the tone. So after reading the requirements, if that is what you are going to work on, you set the tone. How do you set the tone? First, tell the examiner the first page of the book here is your first requirement. Then the other side of the book becomes the next requirement. So first, write the name of the company. This is about P Group. So that's the Premier Group. So I'll tell the examiner, maybe it's my question number 1, A. And then I'll tell the examiner, this is for Premier Group. Then I'll come to Consolidated, please. Consolidated. Then you continue. Consolidated statement of comprehensive income for the year ended. So copy everything. You see that? Just the requirement. Summarize everything. So if I want to write all, it's a consolidated statement of comprehensive income for the year ended. So you write everything there. So consolidated statement of comprehensive income for the year and debt. Have you seen that? Don't forget the reporting currency. In that of Ghana, we have Ghanaian cedis. Check whether they've raised 3 zeros. Raise the 3 zeros for us. If they've not, don't raise the zeros. So I guess they've raised 3 zeros on top. Yes, so 3 zeros. The original question is in dollars, but it has been adopted into Ghanaian currency. So 3 zeros, like this. And then you are done. Then turn to the next page and write the same thing again. B. Still, Premier Group. Consolidated, no shortcut to consolidated statement of financial position. As at, then you code the date. Yeah, I didn't code the date. So you code the date for us. The date is what? 30th September 2010. And line it again. Don't forget the reporting currency, 3 zeros. So right after the requirement and the exam condition, what you have done is called attempt. So when I say attempt the question, it's not by reading, it's by this after the requirement. You've attempted it. Now let's go to the footnotes. So you're using the RAT or the RAF approach. RAF, requirement, additional information, and financial statement. It can also be T, the trial balance. Let's go to the footnote. In consolidation, usually the footnote starts on top of it. So let's go gradually. This is a very tedious question. Like it involves a lot of computation. So kindly be with us. Now let's go. On June 10, it was. Well, what is the year in question? The reporting year. The reporting is 30th September 2010. So what will be the starting point of the year? The year should start somewhere the next day of the previous year. So September, 30th September, the next day will be 1st October of the previous year. So 2010, previous year will be 2009. That's a full year. So the year starts from 1st October 2009 up to 30th September 2010. Any date the examiner quotes, relate it and see. So on June 2010, Premier acquired 80%. So June 2010 up to September 2010, how many months? So don't feel shy to count your fingers. So let's say June, July, in fact, August, and September. How many months? 4 months. Wow. So 4 months consolidation. Wow. 4 months. In fact, one of the settings, we had 1 month consolidation, 1/12. Come and see the story. 1 month consolidation. This one is June to September. 4 month consolidation. Let's continue. That will make it very interesting. Now, he acquired 80% of the equity share capital of Sanford, the subsidiary. So the consideration consists of 2 elements. Wow. A share exchange of 3 shares in Premier for every 5 acquired shares in Sanford. And the issue of $100 6% loan note for every 500 shares acquired in Sanford. Like I said, he acquired a person and issued a loan note. Good. The shares issued has not yet been what? Recorded. So by premium, so meaning it has not been recorded. Share exchange was the recording. So we did a recording, then that is all. But the issue of the loan note has been recorded. Yes. The one that we don't like, they've recorded it. But the good one have not been recorded. Okay. So that is it. Now, this loan, loan have to be repaid back. Equity shares, we don't pay back, right? So you cannot, since they are trading as one entity, parent cannot give loan to a subsidiary. So this loan was used as a what? As a consideration. The subsidiary was looking for money at the date of acquisition, and the parent give out or bought some items. So let's see how best we can treat this loan note. Okay. Now, at the date of acquisition, shares in Premier had a market value of $5 each, and the shares of Sanford. Now, let me explain certain terms to you. Anytime you see the examiner giving you the share price of the parent, we needed to value any share exchange. That means there will be a share exchange in the question. And true, it's for the share exchange. So you must get the number of shares that the parent issued out and multiply by 5. And that'll be the share exchange, the value. And then the shares of Sanford had a stock market price of 3.5. Anytime the examiner also gives you the share price of the subsidiary, then that means they will not give you the Ncdi's total value. So you have to use their number of shares, multiply by this. So number of shares held by Ncdi multiplied by the fair value of the market price per share. That will give us the Ncdi's value. And a good examiner will let you know in the footnote. So below are the summarized draft financial statement of both companies. Statement of comprehensive income for the year ended 30th September 2010. Okay, so that's good news. So parent and subsidiary, all of them, the financial statement there. Revenue. So don't forget that if you are doing 4-month consolidation, so revenue, you take the entire of the parent plus 4 out of 12 of the subsidiary, because 4-month consolidation. Because the subsidiary came in 4 months to the year end, June 2010. No, our year started somewhere October 2009. Good. So take note of this. Gross profit, everything is in there. Now, the finance cost, check carefully. If it is the interest on the loan notes issued, and then how do you treat that one? So it will be here as finance cost, but it will be at the subsidiary section as what? Finance income. To the subsidiary is an income because the parent have to pay the interest on that loan. Good. So let's go. Now, statement of financial position is also here. Now, here as for financial position, we will do a full year consolidation because we cannot prorate assets and liabilities and some part of equity. we can only prorate retained earnings or profits, profit item. That is where we will assume that all profit or loss items accrued evenly throughout the year. So even though it is just 4 months, we must take full year. Now let's go to the footnotes, the important stuff. The following information is relevant. At the date of acquisition, the fair values of Stamford assets were equal to their carrying amount, with the exception of its property. These had a fair value of 1.2 million below its carrying amount, below meaning fair value loss. So you subtract. This will lead to a reduction of a depreciation charge that's charged to cost of sales of 50,000 in the post-acquisition period. This examiner is very good. That's giving us the post-acquisition changes in the depreciation. Good. So if it is a fair value loss, the depreciation should be added back. So that means they've charged depreciation more. So we call it excess depreciation. There's an excess depreciation of 50,000. Who have charged this depreciation? It is the subsidiary. So where subsidiary's profit is in the net assets, go there and then take 50,000 at the post-acquisition period. And then kindly add it back to the PPE because their depreciation has gone up. Now let's continue. Stamford has not incorporated this value change into the entity's financial statement. That's a good examiner. So what you have to do is this: you add this 1.2 million back to the PPE, the property, and then you add it. What happened is this is a loss. So you must incorporate this in the financial statement. Once it's a loss, kindly subtract it from the net assets, both at acquisition and at reporting. And kindly subtract it from the reporting figure on the financial position. And that is all. Okay, then you are done. The same thing applies to the 50,000. The 50,000 will be added to the net asset and to the cost of sales. Net asset and what? Cost of sales. Powerful. And then you add it back to the property on the statement of financial position. Now let's continue. Let's see. Premier good policy is to revalue all properties to current value at each year end. On 30th September 2010, the value of Stamford property was unchanged from its value at acquisition, but the land element of Premier's property had increased in value by 500,000 as shown in the other comprehensive income. Okay, so they had a revaluation gain of the land of 500. Okay, so but here there's a loss on the building, but that one has been recorded, so the 500 has been recorded. You should take note of that. When you go to the financial statement, that is the 500 you see here. Note 1. So let's go down again. Okay, so that's note. Let's go to note 2. Sales from Stamford to Premier, sales for the subsidiary to the parent throughout the year ended 30th September 2010 had consistently be 2 million at a cost to the seller. At the cost to the seller. That's the selling price. Don't assume that the 2 million is the cost price. No.
Please, the question is 1 million per month.
Okay, so you I've jumped far. I want to finish early. Had consistently made 1 million per month. Oh, okay, so the whole year will be 12 million. But please, you can only eliminate the post-acquisition period, the 4 months. So 1 million by 4, that will give us 4 million. That will be the intra-group sales, not 1 million by 12. You can only eliminate the post-acquisition period. So that would be 1 million by 4, giving us 4 million. Sanford made a markup on cost of 25% on these sales. Premier had 2 million at cost to Premier, meaning that's the selling price of the inventory that had been supplied in the post-acquisition period by Sanford as at 30th September. Just find the unrealized profit. So first thing, calculate the intra-group sales. What's the intra-group sales? 1 million by 4 months, making 4 million. What's the accounting treatment? Eliminate it both from the sales revenue and that of the cost of sales. Second, calculate the unrealized profit. The unrealized profit is the goods left in inventory, the 2 million during the post-acquisition period. So you multiply the 2 million by the profit loading. So markup. This 2 million is the selling price, not cost. They intentionally inform you that it's a cost to the parent. Parent was the buyer. So cost to the buyer is the same as what the selling price. Good. So you just have to say that 25 over 125 times this 2 million, that will give us the unrealized profit. It must be eliminated. How do you eliminate unrealized profit? Okay, so just a second, friends online. Okay, so now after computing the unrealized profits, you look for the seller who made the sale. This sale was from the subsidiary to the parent. So the one who made the sale, have made an unrealized profit. That's profit. So first thing in the profit and loss, add it to the cost of sales. So add unrealized profit to the cost of sales to reduce the profit. Then second, you reduce the inventory figure, the closing inventory figure by the unrealized profit. So you subtract it from the closing inventory, and that's all. Then if you are computing the profits, profit from the subsidiary, that would be the net assets. Net assets at reporting, you take it off from the net assets at report, and that is all. Okay, so yeah, then you go to note 3. Premier had a trade payable balance owing to Sanford of 350,000 at 30th September 2010. This agreed with the corresponding receivable in Sanford's book. So once it has agreed, then what do? You eliminate it. So it must be cancelled from both the trade payables and the receivable. That's all. So 350,000 need to be subtracted from both payable and receivable. Call it intra-group debt. Then note 4. Note 4. So this note 3 is a bit okay. What if there was intra-group or there was cash in transit? of goods in transit, which will cause the intra-group debt not balancing. So I think our next question should give us something like that. Note 4. Premiums investment include some available for sale investments that have increased in value by 300,000 during the year. The other equity reserves relate to these investments and is based on their values as at 30th September 2009. There were no acquisition or disposal of any of these investments during the year, ended 30th September 2010. Now here, this is available for sale, and the value has increased by 300,000. Now, how do you treat fair value, or how do you treat fair value gain on financial assets held for sale or available for sale? We also call it fair value through OCI. So this fair value gain should go to OCI. Simple. So kindly add 300,000 to the parent OCI and add the 300,000 to the investment. So go to the financial position, the investment to be there. Financial position, where I go, the investment here. So the investment, this investment. Okay, so the investment in here. So this investment, it has increased. So add the 300 to the 1,008, you get 2,100, and that is what in the new balance sheets you will include, or you treat the investment. That is all. Let's go to note 5. Premier's policy is to value the non-controlling interest at their fair value at the date of acquisition. For this purpose, Sanford's share price at the date can be deemed to be a representative of their fair value of the shares held by the non-controlling interest. So, like I told you, we just have to take the NCI's number of shares, then you multiply it by that of the, the share price at the date of acquisition, and that is all. So now that we are done with the footnote, you now start. First thing that you do is to consolidate just the financial position and then the P&L. So just write all of them. So when they move, you move. When they stop, you stop. So good. So let's see it again. Okay, so let's see. So now everybody can write this. So go to the P&L and start with the consolidation. So write it as I write. Though the board is too little for this entire work, but what we'll do is this. You will copy the skeleton, then I'll do the computation. You put them in, and then it's balanced. That is all. So let's start. So start from revenue. When they move, you move. So go to the financial part, the one that you start with first. It does not mostly matter. What matters is the writing is going in. Look, okay, so let's start as they also started. So revenue, that's question 4. Revenue. So they start from revenue, cost of sales. So I'll start revenue. So revenue, parent owned plus the subsidiaries owned. So if you have the question, kindly open it in another device so that we do it together. So let me open it. Okay. So where's my question? Okay. Good. So I'll start from the revenue. So right here, revenue. Because we have gone through the footnotes already, some of the figures look a bit okay. So parent own is 92,500 plus subsidiaries own 45,000 less the intra-group sales. So that is the 1 million.
Please, what about the 4 months?
Okay, so in fact, we must take the 4 months of all. So times the 4/12, or we can bring that one in front so that we finish it up. Because we are doing 4 months consolidation. So 4 out of 12, that is the same as 1/3 of 45. So that means all these figures you have 5. It must be divisible by 3. All Sanford figures should be divisible by 3. Wow. 45,000 divided by 3. That would be 15,000. 36 by 3. Okay, so 9,000. 3. Okay, so now plus the 1 million, that's 1,000 times 4. Have you seen this? 1,000 times 4. In fact, it's not plus, so it's minus. Then we are done. So this will be the sales revenue. Have you seen where it has ended? So I'll be mentioning it and then you write it for me. And I'll actually be doing the computation, the actual workings, and then we put them in. So as soon as, make sure that you move with us. So kindly have your skeleton there, your structure down. Go to cost of sales. So cost of sales. Usually cost of sales will not go on the face. So you perform a working on its own. Or you can start like this and then work them here. So 92,500 plus 4/12 of the cost of sales of the subsidiary, which is 36,000. So 1/12 times 36,000 cities. Then again, minus the 4,000. That's a 1,000 by 4. Then you wait. If there's any other item, we charge it to it. They've mentioned in fact the informer's cost of sales, the asset depreciation that they've charged. So that one will add back, it must be reduced. So the depreciation is high. Okay, so now what I'll do is this. Because of the space, I will project it and then you move with the cursor. So we are going to use the cursor to do consolidation. So now we are at cost of sales, we've done that. So now go to gross profit. When you go to gross profit, don't write anything there. Kindly move as we move to benefit fully. Let me see everyone writing something down. So go to gross profit. Don't write anything there because you've not finalized your item. Now go to distribution. And then you open the, in fact, nothing was said about distribution and administrative expenses. So these two, you can close them. So go to distribution, parent own. What's parent own? 2,500 plus 4/12 of 1,200. That'll give us 400. And then you close it because there's no notes. And then you move on. Because the subsidy was acquired.
Net is not stable.
Good. Okay. So let's do it that way. So when I move, you move. So kindly do it when I put the highlighter on it. So let's go to administrative expenses. Now do you pick 5,500, then you add 4/12 of 2,400. 4/12 of 2,004. That will give us 800. You can close it and you move on. Okay, so the loan notes or the finance cost, you open a bracket and bring the 100, then you pause for now. In that order. Then when you're done, then go to your profit before tax. So when you move. Profit before tax, don't write anything there. Okay. Okay, so now let's all move on to the income tax expense. So from profit before tax, don't put any figure there because that one. Go to income tax. Income tax too.
Please, what about the finance cost?
So the finance cost, you open a bracket and you put 100 there for now.
Okay.
If at the end of the day we need to cancel it out, we just subtract the 100 back again and then get 0. After we calculate the intra-group loan or we calculate the loan that was issued as way of the cost of consideration, then we come back to the finance cost and then adjust it. Good. So for the meantime, we just open and put 100 there without closing the brackets. Good. So that's how we have to do it. Then we move on to profit before tax. And then we put it there. Profit before tax, don't put any computation. Go to income tax. Income tax, open a bracket. 3,900 plus 4/12 of 1,500. And that'll give us 4,400. This one, there's no notes that was said about tax. So that one, you can push the answer straight up. So for tax and then the distribution and then the administration expenses, these three, they are free of charge. Nothing else will affect it. Good. So that is the game. Then when you are done, you move on to profit for the year. Leave it empty. Let's all go to profit for the year. Leave it empty. Then write other comprehensive income. The other comprehensive income. And then you open a bracket. So the other comprehensive income, you come down, gain or revaluation of land. Leave about 2 lines there because we are going to put additional revaluations. I think there was a fair value loss of 1,200. So you create a column for it. Then when you are done with the comprehensive income, when you are done with the revaluation gain, please leave about 2 lines or just a line there. Underline it. Now you have total comprehensive income. So kind of align and your total comprehensive income, and then you leave it empty. After that, do this. This one have to do it on the board. So now let's go to the board. After your total comprehensive income, now tell us. Let us assume this is your total comprehensive income. So much. Now come and tell us that profit for the year. You must share 2 items here. Kindly share the profit for the year and as well as what the comprehensive income. So set example the profit for the year attributable to the owners of, you mentioned the parent name, owners of the parent. Mention the parent name, that's a premium. Either I write parent or premium, any of them, you are free to go. Then right here, NCI. NCI. Then underline it. There will be a figure there, don't write anything. So don't write anything there for now. Then come again, then come and write total comprehensive income attributable to. Total comprehensive income, in fact, attributable to the owners of, so owners of, then the same parent and NCI will come down. We must share the profit for the year and also must share the comprehensive income. And then that is all. So do this skeleton and then let's go to the financial position. Let's go to the financial position. Then we'll provide you with the computation or the working. So let's go to the financial position. This is the balance sheet. First thing is to list the non-current assets. And then also you have to create a column for goodwill. Very important. So right here, when they move, you move. Just follow their formats. So they started with assets. So you need to write assets. I hope you have it there. So, but it's too late. So kindly do that for us. You write the assets. Now move on and write non-current assets. When they move, you move. Non-current assets. From the asset, they went to non-current assets. We've already provided the format, the name, the headings, the currency already. So you don't need to repeat that for the financial position. Can you write PP, property, plant, and equipment? As for, obviously, no shortcut. The examiner never wrote PP, he wrote in full. So kindly write your own to in full. Then you open a bracket as usual. For consolidation, it must be full, but we can't divide the assets. No. So that one will be 5,500 plus 13,900. Don't close the bracket. Maybe some of the footnotes will cause an adjustment to the PPE. Then you come and do that. Then go to investment. Now, when you see investment, there's a difference between investment in SAP. There's a difference. After you have listed all the items, when you bring the goodwill.
Okay.
Or either goodwill have to be first. Either goodwill. If you know that you will not remember goodwill, then let your goodwill be first item on the list. But if you know that you remember goodwill, then let goodwill be the last item on the list. That's for the non-current assets. So take note of that. If you remember, goodwill, after you've listed all your assets, goodwill come last. If you don't, in fact, maybe if you don't want trouble, just write the goodwill first and be safe. But sometimes you list all the assets and you forget that there's even goodwill that you have to go and calculate. So that is it. So let's take notes of that. Now let me explain these two terms. They are not the same. They are treated differently. When you see investments, now investments, only the term investment, kindly consolidate it. Bring it, open a bracket, the 1008, bring it like this and leave it. They are going to adjust it. Subtract the fair value or the cost of control which has been recorded from it before you get the other investments. So that one will do the consolidation. When you see investments, you subtract the recorded cost of control. Recorded or not unrecorded figure, please. So that is it. Now let's go to the next term I want to explain. The next I want to explain the same investment, but they'll tell you that investment in the subsidiary. They'll mention the sub's name. So you have to be investment in some form. That one don't consolidate it. We don't consolidate investment in subsidiary. But if you see investment, then it means that it may include the subsidiary's own, sub's own, plus other investment. No wonder we pick it like this 1008 and we say minus any cost of consideration paid to what the subsidiaries. So that's the sub's one. We don't consolidate investments in subsidiaries. So let's take notes of that. So kindly bring this investment because they said investment. They didn't say investment in subsidiary. They didn't mention any subsidiary's name here. So kindly bring it. So when you move. I hope you are doing the same. So write investment and open a bracket, 1008, then leave it. Then you bring your goodwill. If you have not done that, bring your goodwill. If your goodwill was first two, you put it there. So that is it. Now, after that, then you move on. When you move to the total it. So you also analyze it as if you are come to total. But sometimes the advice is that you may leave a line. Maybe if there's any item that will pop up from the footnotes. But this one that we have read the footnote fully, then we are 100% sure that nothing else, all the adjustments will be done on the first. So you can do it without leaving a space. Then you go to current asset. You know, here the current asset has been fused. They didn't give us inventory, no receivable, no cash and bank balances has been fused together. So write current asset and also open a bracket. Parent owned plus a subsidiary. Any adjustment that will affect the current asset item, kindly affect it with it. So for instance, something like the intra-group inventory or the unrealized profit on the inventory, it will affect it. So we need to adjust it. And then the intra-group debt, you come and then subtract it, and that's all. Then you get your total asset, then you move on. So you're moving line by line. So you get your total assets. So from there, you also write your total assets. Now let's go. Total assets. total assets. Okay. Now the total assets, all what you have to do is you double underline it as if it has balance. Then you go to equity. When they move, you move. From there, they went to equity and liability. So let's go. So you write equity and liability. You are copying everything. When they move, you move. When they stop, you stop. That's all. Okay, so they started with equity. They wrote equity, so you write equity again. Then you write equity shares of $1 each or $1 each. Here you open a bracket. You only write the parent equity. We don't consolidate the equity of the subsidiary. It's the one that we transferred to compute the net assets at acquisition and at reporting. And that is the one that we use to compute the goodwill. So the net assets of the subsidiary, it includes the equity item. And then the difference between the equity item, let me give you this genesis so that you can get the understanding clear. Now, when you start the computation, the cost of consideration, you said that we don't consolidate it, right? Okay. Maybe it is 30 Ghana or $30. Cost of consideration is $30. The net asset of the subsidiary, let's assume, is also $20. So therefore, the difference, let's assume this is 100% acquisition or 100% control. So this is 10. So this 10 is the goodwill. So that means any item that we use to compute the goodwill need not to be consolidated. It includes the cost of control. That is the investment amount paid to acquire the subsidiary. If it has been captured under the asset side, take it off. And then the net asset of the subsidiary. These are the two that we use to compute the goodwill. So therefore, don't need to consolidate it. That is it. Now let's continue the game. Now, when you come to land revaluation, can you bring it and open a bracket and put the 2,000 there? After we read the notes, then we adjust, or after we start the computation. Good. Then other equity reserve. As at 30th September, note 4. Also bring it and open a bracket. Any section. Then you go to retained earnings. That one, don't write retained earnings. Don't write retained earnings. Just write what? Group retained earnings or group income surplus. So group retained earnings. That one, don't put anything there. That's the workings that we have to do. Workings number 5. Then right from there, you put them together.
Good evening. Hi, boss.
Okay. So right after the retained earnings, kindly add all the equity together. Add all the equity we've added. So add your own. Don't write any figure there because your own is empty. Now, right after that particular one, let's move on. Write non-controlling interest before the liability. So write non-controlling interest right after the equity, after the total of the equity. Write non-controlling interest, NCI. So non-controlling interest. So after the total equity, then write non-controlling interest, NCI. You leave it without putting anything there. And you move on with the game. So move on with the consolidation process. Then it comes non-current liability. If you put non-current liability there, you also do the same. Then 6% loan note. Open a bracket and make the 3,000 there until you compute the cost of control or cost of consideration. You might not be able to decide whether the entire 3,000 is the cost of control element. Good. Okay. Then current liabilities, you open a bracket, 10,000 plus 6,800. Then we now sum everything together. Everything together. And that's all. So now we are done with the skeleton version of the consolidation. I'm now going to work out the notes one after the other. So as and when I work out, then you put them in the skeleton. Then when the last notes stand, add them and then you move on. So let's all join and then work it out. But you cannot afford to make this section. Let's put the pieces together. So as and when we do the computation, you present it on the face, and then you have the full. So let's start with the game. Now, because you have your P&L with you, we'll start first working. So your workings, I'm starting from this angle. So workings. Workings one is the group structure, right? So A, our third example of group structure. So the structure is like this: parent. I put the parent name here, in which they call him Premier. Okay, so then I'll put the subsidiary name here, Sanford, 80% NCI with 20%, agreed. I'll now add and get 100% very fast. That's the 1A, 1B. In fact, effective date of what? Effective date of acquisition or control. They tell us 1st of what? June 2010. C, period of consolidation. consolidation. You need to be fast here. First consolidation, 4 months. That's all. That's the first workings. Actually, this working does not go anywhere, so don't need to post them anywhere. So get them, and then let me take them off again. New workings number 2. Now, since you have your P&L first, the workings, it doesn't matter. You can mix them up for us, just that have like the heading and name by name. So let's start. Okay. So workings number 2. Workings number 2. Since there's P&L, can we deal with the P&L workings? Then any workings that you can do, bring it next. So when you start, you can also start with the financial position workings, the standard 6 that we have there. You can do those ones. So let's see if we can deal with them. So my first workings, or workings number 2, I want to go in order, like the way I gave you for financial position. Is the cost of what? Cost of control or cost of consideration. Cost of control. So cost of control, let's go to this question. It's made up of 2 items. So let's go and compute the 2. So the question says something nice here. So on top here, let us be a bit fast to balance it off. Please follow up. If you put them together, it will balance nicely for you. So they're saying that the consideration or cost of consideration consisted of 2 elements: a share exchange of 3 in the parent for every 5 acquired. So 3 for 5. And then the share price is 5 cedis. So now you have to find the number of shares acquired by the parent. Number of shares acquired by the parent. So parent acquired 80%. So let's go and pick up the number of shares of the subsidiary. So equity, $1 each. So that means the subsidiary have 5 million equity shares, because $5 million divided by $1 will give us what? 5. So 5 million. So that's the entire share. So 80% of 5 million, that will give us the number of shares acquired by who? The parent. So here you write share exchange. Okay. So here to get the number of shares acquired by the parent. So number of shares acquired by the parent. Pick the percentage holding, 80%, multiply by the total number of shares of the subsidiary. Now this subsidiary have 5 million stated capital at a nominal value of $1. So here will be, so divide this by 1, you get the same 5,000. So 80% of 5 million shares. I've read 3 zeros, so that's why we are working with this. The 4 will be something like this. So this will be the number of shares acquired by the parent. So when I put it this way, is the number of shares acquired. So 80% means 4 million. So parent acquired 4 million. That's why he had 80% control. That's all. Now, right here, cost of consideration or cost of control, and start share exchange. Share exchange. open a bracket. First of all, get the ratio correct. There's 3 shares in P, the parent, for every 5 in S. So we call this 3 for 5. Always please let the parent share come on top. The number of shares the parent is giving out. So we call it the new shares you are giving out all over the shares acquired or the existing shares. Acquired shares times total acquisition, total number of shares. So here, parent own is 3 out of for every 5, so over 5 times the total number of shares that the parent acquired. That works onto this. Total number of shares is 4 million, right? So times the 4,000, that will give us the number of shares given out as exchange. Then you multiply this by the share price of the parent. Please don't multiply by the share price of the subsidiary. These shares are not given out by who? By the subsidiary. It is the parent that's giving out the shares. So therefore, pick the parent share price and multiply by. Good. So here, let's do the entire computation. So finally, putting all this computation together, it will be, first of all, pick the ratio, 3 out of 5 times the number of shares acquired. Number of shares acquired is 80% times the 5,000 divided by $1. Close it. This is the number of shares given out times the share price of the parent. We're told that is what, $5. So times $5. In fact, we have converted all the currencies to cedis. So I like working in cedis. So let's work in cedis. So it will be times 5 cedis. And you put the answer in. Don't forget the 3 reporting currencies. So times 5 cedis. So now, when you do the computation, you get a very nice figure. So let's go. 3 divided by 5 times 4,000. That'll be 2,400 times 5. So 12,000 cedis. That's the amount. So I'll put 12,000 cedis here. Now, kindly be with us. Let's go to the question. We're told that the share, it said that the share issued has not yet been what? Recorded. So they've not recorded it at all. So what do? Let's record it. So how do you do the recording? The first treatment is bringing it here. Is the first recording. Second, add to the share capital. So go to the share capital, the equity shares. You open a bracket there. You've recorded the parent own. Kindly add 12,000 to it. That's the second. And close it and push the answer in. Kindly do that before we move on. Other than that, your own not balance. So the share capital that you pick only the parent own. Only the parent own, which was 12,000. Add another 12,000 to it. You get what? 24,000. And then you now, so you push this 24,000 cedis to the balance sheet. And then we move on with the game. Okay, so that is all. However, This question has been adopted in the ICA system or in Ghana system. In Ghana system, our company's code forbid a premium on shares. So our shares don't have a par value or nominal value. So that is how we will solve it. But in sections where shares have a par value, that is the originally, if we should solve this question under the ACCA section, then it means that we must divide this 5 cedi into 2. The nominal value is what? $1. And then the premium will be $4. So $4 goes somewhere else. Good. So the $4 goes somewhere else. The $4 goes to the share premium account. So you put the $4 in the share premium. But in Ghana here, everything goes to one account. So in Ghana here, the share capital or the stated capital and the share premium account is fused together as one. So we don't have par value or nominal value of shares. So in situations where we have par value, so typically for the cost of control computation, this is how we do it. That one has not been affected. So for cost of control, whether the share premium or not, it will not be affected. So you still have your 12,000 here. But when you go to the statement of the financial position, and then you are going to add it, so you write your equity, open a bracket, it was 12,000, now plus. So here you divide it into 2. $1 goes to the equity stated capital, and then $4 go to the share premium. So share premium will now be, you get the number of shares issued out. So the number of shares issued out will be just 3 divided by 5 times 4,000. I had 2,400 shares. So that means by $1 will be 2,400. And then the share premium to take the remaining. So times 4. That will be 9,600. So the share premium should be 9,600. This is for ACCA. So if this question is solved under ACCA, this is how the equity section will be completed. But for ICA Ghana, we fused everything together. So you add 9,600 plus this will give you the 12,000. You add it to the 12,000, get what? Get 24,000. You are free to go. So take note of this computation. And then that is all. So kindly add it there and you have 24,000. Push it to the final section. So kindly put the 24,000, push it to the final section, and then we move on with the game. Okay, so that is all about this. Okay, so let's continue the game. So now, the consideration is also made up of what? A loan note. They issue a loan note. So let's go and read a loan note. Now, how do you treat loan notes? Let me explain this. It's treated normal way of issuing shares. So normal way. So let's go and pick that particular one. So come here. They said that an issue of $100 6% loan note for every 500 shares acquired in some form. So every 500 shares you can for $100. So how many shares came, and then what will be the total value of loan note issued? Let's go to the computation. So here, instead examine a loan note. Open a bracket. Now, they say 100 for every 500, right?
Yeah.
So put the $100 on top, divided by the $500. times the total number of shares acquired. This section, this is the total number of shares acquired, which is the 4 million. So the 4,000 here, close it, and that'll give us the value. So the same as 4,000 divided by 5, that's 800. So here will be 800. Now putting all this together, this has been recorded already. So there's no need for us to record it again.
Please take it again. The sound is a bit low. So.
Okay, so here we have issued a debt. We have issued a debt to acquire a subsidiary. So that is the loan. So that 800. In fact, how do you calculate the value? They say for every $100 for every 500 shares acquired. So therefore, how many shares, total shares acquired? We've acquired 4,000 shares, and for every 500, we are giving out a debt of what? 100. So therefore, the $100. In fact, I think like I'm mixing the currency. Let me use just one currency throughout. So avoid confusion. Let me go back and use the dollars because originally stated at dollars. So the $100 over the 500 shares times the total number of shares acquired. This is the computation here, the one we call 80% of the entire shares of the subsidiary. That is it. And that gives us 800. Now, how do you treat debt used as what? Consideration. It's normal way as you use your car or your shares to acquire subsidiary. So it must go to its respective place. It must be added to the liability. Any interest paid on this should be accounted for accordingly. But it need not to be noted. So basically, if we should end here, we add the two together, the total cost of consideration become 12,800. That's the total cost of what? Consideration. Total cost of consideration become 12,800. So we are done with the cost of consideration. 12,800. Then we are done. Let me be a bit fast so that we can finish all. Good. Let's go to workings number 3, net assets of the subsidiary. Net assets of the subsidiary. Net assets of the subsidiary. Now, net assets of the subsidiary. Good. Okay, now this consideration, before we end it, the loan note consideration, this should be net off from the available for sale investments. So this, usually if it has been included in the available for sale investments, then we go and then take it off. So let's go to the notes so that we can complete this fully. Let me hold my calculator firmly. So let's go to the financial position. Now, have you seen these investments? These investments, it includes the 800 because they say it has been what? Recorded. So let's all go to the financial position, subtract the 800 from the investment. We said that we don't consolidate what? Investment. So go there, the 1,800 less 800. Please don't close it until further notice. Good. Now, the loan note that they've issued has been recorded, so it has been added to the investment. We go there and subtract it. We don't consolidate any investment that the parent paid to acquire what. We don't consolidate any investment or any consideration paid to acquire the subsidiary. He has issued a loan note of 800, consideration of 800. So this 800 is part of what? The investment. So go there and less the 800 from it. So this is the first treatment, and then the second treatment, we take it off. And then that is all. Now, don't close the bracket until further notice, because I think they mentioned it again. So we are done. Let's go to the next work. Working number 3, net asset of the subsidiary. So net asset of the subsidiary. Net asset.
So always loan notes are always added to investment.
The loan notes, you look at the treatment, how the examiner treated it, and then you have to do what? Reverse it. If it has been added to the consideration. Now they told us that they have recorded what? The loan note. So that is why we are reversing it, because we don't consolidate investment. That's all. Investment in the subsidiary, anything that you pay to acquire the subsidiary, do not consolidate it as an asset. Because to be transferred to the goodwill calculation. Good. Once they said that the loan note has been recorded, it means automatically is in the investment. So it has been recorded. So 2 places. When the parent issued a loan note of 800 to acquire the subsidiary, the parent recorded the 2, debit and credit. Tell us the debit side, tell us the credit side before the term balance. Now, the parent recorded this as a loan. So that's the credit side. So we add it to the loan. The debit side, we add it to investment. Investment is an asset, so have a debit balance. So automatically, when the examiner inform you that, oh, it has been recorded, this is the treatment they have done. You maintain this and you eliminate this, that's all. And then you move on with the game. This is December 2010 ACCA financial reporting. Okay, so let's go straight to the net assets of the subsidiary. So net assets of the subsidiary. Net asset of the sub. Now we have at acquisition, then at reporting, then post acquisition. Let me still come back to the dollar and use just one currency and move 3 zeros. Now, here we must go to the financial position. So pick all the equity items that you see for the subsidiary, not the parent. Or the subsidiary, not what? The parent. So I can see equity share 5 million or 5,000 there, and retained earnings 4,500. Now this retained earnings we must calculate as at acquisition. So let's see it. Right here, equity shares. Right here, equity shares. Equity shares is 5,000. Record the 5,000 throughout. Post acquisition period should be dash. Right here, retained earnings. Retained earnings. Now, the figure given to us in the financial position is at reporting. Record that one first. So the figure there is at what? Reporting. That's the 4,500 is at reporting. You must get the retained earnings at acquisition because it has reporting because on the balance sheet, all the balance sheet figures is called at reporting. Now, we want at acquisition. Now, this is at reporting. This is 4 months. But this period is 6 months, and this is 8 months, and then 4 months. This is, let me do the diagram wall for you to get a clear picture. Okay, so this is our starting point. This is the reporting. This is somewhere the open balance, beginning of the financial year, which is somewhere 1st of October 2009. That is the open balance. This is at acquisition period. So from here to here is 8 months. From acquisition to reporting is 4 months. So here we need the retained earnings as at this day, as an acquisition. There are 2 ways of computing the retained earnings there. Find the whole year profit, or the whole year profit, and share. Find the 8 months of it, find 4 months of it. So go to the question and pick the whole year retained earnings. So the profit made for the subsidiary from the P&L. So the whole year, the profit made is 3,000, but it's 3,900, this very one. Now this 3,900, share it between 8 months and what? 4 months. So 3,900 times 8 divided by 12. And that is 2,600. So that means 8 months, the profit made here is 2,600. Profit made here to be 3,900 minus the 2,600. That's 1,300. Okay. Now, we have the retained earnings here at reporting. The retained earnings is 4,500. So now I want the retained earnings here. There are 2 ways of looking for this. To get the retained earnings here, I must now subtract this from this. It will give me what is here. Because whatever retained earnings I have here, something which is here, plus from here to here will give me this 4,500. I'll be getting. So therefore, 4,500 minus 1,003 will give me retained earnings over here. So let's go. So 4,500 minus 1,300. That's 3,200. That's the retained earnings at what? At acquisition, 3,200. So when I add this, I can get the 4,005. Again, I can also start from here. That is the alternative. So to calculate the retained earnings at acquisition, retained earnings at acquisition computation. The first formula, we started with the retained earnings at reporting. So at reporting is 45,000, sorry, $4,500 is on top, 3 zeros. Then we say less what? Post-acquisition profits. Less the post-acquisition profit. We had 4 out of 12 times the 3,900. And we had 1,300. We subtracted it. And we had 3,200. That's the retained earnings at acquisition. Alternative, this is method 1. Let's go to method 2. Method 2, start from the retained earnings at the beginning of the year. So the whole year profit is 3,900. Subtract it from this figure, the 4,900, to give you the retained earnings at the start of the year. For the whole year, they made a profit of 3,000 and take it off from this to give you the opening balance. So method number 2, so I'm calculating retained earnings at acquisition. Third examiner, opening balance or balance brought down. Open a bracket, it will be 4,500 minus 3,900. So that's the retained earnings at the start of the year. Let's go. 4,500 minus 3,900. 600. So the retained earnings at the start of the year 600. Then add pre-acquisition profit to it. Add all profit made before acquisition. So pre-acquisition profit. That one is the 8 months over 4 times 3,900. Is the one that we just calculated here, 2,600. Add, what do you get? 3,200. So whichever method or whichever way you are coming from, the final answer needs to be what? The same. So I'm done with this retained earnings at the state of acquisition. So with the computation. So kindly take one. So here's 3,200. The difference between this and this will give us what you call the post-acquisition profit of 1,300. This one is this, you put it there. Now, right from here, then you start with your fair value adjustments. So we go and then compute our fair value adjustment. So let's go and then look at the fair value adjustments, and then we move on with the game. Now the fair value adjustment, we need to just work it out.
Charlie.
Need to work it out, and then we move on with the game. How best we can get a fair value adjustment. Let's go to the note. Note 1, I think, yes. At the date of acquisition, the fair values of Sanford asset were equal to their carrying amount, with the exception of an item of property. These are the fair value of 1.2 million below its carrying value. Stop there, below its carrying value. So go through treatment. Below means it's a fair value loss. So right here, fair value adjustment, and right here, property. So when you write here property, just put 1,200 here, so 1.2, right? Below means loss, so put in brackets. Put in brackets. Here will be dash. Okay, so that is that. Then this one will create what you call excess depreciation. But immediately, please let me give you another trick. Any item that you record at reporting goes to the balance sheet again. So go to the balance sheet and go to PP, subtract 1,002 from the PP. So go open your PP, subtract 1,002 from PP. Powerful. Let's continue with the adjustments. Read further that this will lead to a reduction of depreciation charge in the cost of sales of 50,000 in the post-acquisition period. So this means that the fair value loss will create what you call excess depreciation. So depreciation has been charged more because the fair value has gone down. If you use a higher cost to depreciate the asset. So therefore, third examiner right here, excess depreciation. Now the excess depreciation is 50. Can you put it at reporting? Here, they have subtracted the depreciation, add back, so to be positive. Don't subtract it, positive. Add the same thing here too, in addition. Again, any figure that comes here must go to the financial position. So go to the PPE, add 50 to the property. Go to the PPE, add 50 to the property. Let's do that. Have you done that? Powerful. Okay, so 50 comes here, 50 goes here. Again, when you are computing the cost of sales, 50 will be here. And that is all. Let's go to the last item, and then we are getting to the tail end. Is there any other item that will go to net asset again? That is the unrealized profit on intra-group sales. So unrealized profit. Now this 50 will be added, in fact, back to the profit. It's the same as we subtracted it from cost of sales. So this 50 should be subtracted from cost of sales. So if you have a space, go to cost of sales and subtract 50 from it. If there's no space, don't worry, we did a computation. Now let's go to the unrealized profit. So let's compute the unrealized profit. Who made the sale? The sale was from Sanford to the Premier. So that means it is from the subsidiary to the parent. So it is the subsidiary of made what the unrealized profit. So let's compute it. The markup is 25%, but the selling price is 2 million. So third examiner, unrealized profit. Unrealized, open the bracket. It will be 25 over 125 times the 2 million. Is the 2,000. So let's see. 25 divided by 125 times 2,000, which is 400. So put a dash here and put a 400 here. Kindly subtract. Put a 400 here. Kindly subtract. Okay, immediately there's a figure here, right? So go to the balance sheet. This should be subtracted from inventory. The inventory figure should be reduced by 400. So go there and go and subtract from inventory. However, our balance sheet, the inventory is fused in the current asset. So go there, the current asset less 400 from the current asset. So go to the current asset and less 400. Current asset less 400. Can you do that? Then we move on. Good.
Once it affects cost of sales.
Now, again, you add it to cost of sales. So can you add 400 to cost of sales? Add 400 to cost of sales. I'll prepare the cost of sales again. That's all we are done with this treatment.
Please, we add or we subtract?
Good. Cost of sales you add because it's a cost to the organization. Unrealized profits. Here we are subtracting to reduce the profits. But in the cost of sales, we add the cost of sales so that when you finally subtract from sales revenue to reduce the profit. Good. So that is all for this particular section. Now that equity instrument or that how do you call it? The investment we're talking about to affect the parent, so to not affect the net asset computation. And again, they mention another land and building. Land and building somewhere. Okay, so this is it. That is the starting from this angle. So premium Previous group policy is to revalue all property to the current value at each year end. On 30th September 2010, the value of Sanford property was unchanged from 8th acquisition date. That's very good. But the land element of the parent property, so this one affects the parent. So let's take note of this. It affects the parent. Powerful. I like this question. Okay, so therefore we are done. Let's sum them up and get the total value of the, let's get the total value of the net assets, both at reporting and then at what? Acquisition. So sum them up for us and let's get the net assets at acquisition. So net asset at acquisition will be?
At post acquisition is 950.
Good. So to compute this, we will have, so when I add everything together, so 5,000 at acquisition, let's go 5,000 plus 8,200 less 1,002. That'll give us 7,000 at acquisition. So 7,000 at acquisition. And you said that post acquisition would be
950.
950. So
At reporting 7,950.
7,950. And then that is all. We are down with the net asset both at acquisition and at reporting. Let me clear this side so that to be a bit clear. Now, when we move so that at the end of the day you balance it, because at the end of the day I'll show you my balancing figure. And you must also show me your own. And then we move on with the game. Let me totally come down. Okay, so now you can capture every section. Let's go to workings number 4, goodwill. So computation of what? Goodwill. Here we are using a full goodwill method, full goodwill. Okay, so that side is not coming clear. Let me step him down. So goodwill computation. That's workings number 4. Now, goodwill is the difference or is the excess of the purchase consideration over the net assets acquired by the parent or the investor. So first, cost of consideration or cost of control. So cost of consideration, in which we computed it, we had 12,800. Then here, because we are using the fair value method, we must now add the fair value of Ncdi at acquisition. The fair value of the Ncdi at acquisition will be computed using the number of shares held by the Ncdi. Now, the number of shares held by the Ncdi from the parent acquired 80% of 5,000. So Ncdi will have what? 20% of 5,000. That will be 1,000. So the number of shares held by the Ncdi is 1,000. Then you multiply this by the share price of the subsidiary at the date of acquisition. And that is what they give it out to be 3.5. So $3.5 each. That's the share price of the subsidiary. So therefore, the fair value of the Ncdi at the date of acquisition should be computed as follows. Yeah, 20% times 5,000, that'll give us 1,000 times the 3.5. That'll give us 3,500. So you add the two together so that you can get the total consideration transferred to acquire a subsidiary. So 12,800 plus 3,500, that should give us 16,800. Sorry, 16,300. So we call this one total consideration transferred to acquire the subsidiary. Less the net asset at acquisition. So subtract net asset at what? Acquisition, which is 7,000 here. Okay, so therefore, so 16,300 and 7,000.
9,300.
So the goodwill is 9,300. That's the goodwill. No impairment. The last footnote stated that this is goodwill. No impairment. Last footnote stated that there's no impairment after the end of the reporting period. Let's go there. I think we did not read that one. Okay, so let's go there. Last footnote, there has been no impairment of consolidated goodwill. So thank you. No working. Okay, so we are done with the goodwill. Can you go and put it in? So go to the goodwill column and put the goodwill there. 9,000. 9,300. So can you put it there for us? How have you done that? Okay, so once you've done that, good news. Now let's go to the main workings. Workings 5.
Yeah.
Group retained. Let me do it here. Group retained earnings. Workings number 5. Group retained earnings. Can you put them in? So workings number 5. Group retained earnings. So the group retained earnings, all what you have to do is this. All what you have to do is start from all of the parents. So pick the parent retained earnings at the end of the reporting period. So parent retained earnings at the end of the reporting period is in here, which is 12,300. So 12,300. Then write the subsidiaries only Sanford. Open a bracket for the subsidiary. Now the subsidiaries own, you open a bracket that, oh, the post-acquisition changes in the net assets. You take the parent share. So parent share will be 80% times the 950. So 80% times the 950. Go the parent share. So dot 8 times 950. That will give us 760. The remaining one goes to the NCI. So 760 comes here. And any other item that will affect the group reserves, you adjust it. So any other item that will affect the group retained earnings. Over here, nothing else again that will affect it. So if there's nothing else, we are done. What the good news? The good news is that only 2 items. And that means that in the case of NCI, it is the same thing will happen there. What's the good news? So just add these 2 figures together. 760 plus 1,300.
13060.
Go, so 13,060. So kindly go to the balance sheet and go and put this one there as group retained earnings. Please, when you go to the balance sheet, if you go and write group retained earnings there, kindly put bracket workings number 5 against it and put it there. So 13,060. So can you do that for us? How have you done that?
Yes.
Good. So go to group retained earnings and put 13,060. Follow everything one after the other. By the time you finish, you sum all up, you have a nice balancing figure. If you miss anything, any step out, you no balance. So when I finish, I'll write my balancing figure there. I'm also writing it here in my calculator. So that is it. Now from here, workings number what? 6. NCI at reporting. Let's find the NCI figure. NCI. Oh, clean this one. Sorry. Let me clean a good one. That is one. It's not plenty, so you are fine. NCI at reporting. The workings number 6. NCI at reporting. NCI at reporting. Now, bring the fair value of NCI at the date of acquisition. Take it from the goodwill computation. We had 3,500. The NCI at acquisition, 3,500. Then add the NCI share of what? Profit. So NCI share of profit. So share of profit. Open the bracket. This 950, their share will be 20% of 950. There's no impairment. So the 2 times 950, 190. Ah. So 3,000 plus 190. So 3690. So now go to the same balance sheet where you NCI. The NCI figure there. Can you open a bracket? That is on the workings number 6. Put 3690 there. NCI right after the total effort. Okay, so we are done with this. Now, once we are done, we can even finish the balance sheet before moving on to the P&L. Yes. So let's be some 2 or 3 items, and then we are done with the balance sheet as a whole. So let's go to the footnote. Now the P&L, the first working that I'll do is the cost of sales. So the P&L, let's go to the cost of sales computation. You've seen it already, but I'll still look at it again.
Please, I have a question here. With the 3,500 under the fair value of the NCI,
Yes, please.
please, where was it taken from? It's missing.
Okay, so 3,500 is a fair value of NCI. It's coming from the goodwill. The goodwill computation, we started from cost of consideration, 12,800. Then we calculated a fair value
I'm
of
okay.
NCI, 3,500. Agreed.
I'm okay now. Yes.
Now, we move on to the face, and then we can close some of the balance sheet item. Now we are done with all the compulsory working. What left is cancellation and the close of accounts. That's all. So first thing that I'll do is to go through the note number
3.
So let's do note 3. Trade payable balance owing to Sanford of 50,000. So that is parent is owing 50,000 to Sanford, and it has balance. Once that's balanced, notice. So subtract 350 from the current asset and subtract the same figure from the current liability. Let's do that. So the current asset, kindly subtract 350 from it. Your current liability, subtract 350 from it. Current liability, subtract 350 from it. Good. And then that's also that note, you can now strike, in fact, strike out that note because you are fully looking that. Then we are done. Let's go to the cost of sales and fill in the P&L also small. Now the cost of sales computation, you have it already, but I want to do it here on its own. So cost of sales computation. Confirm that your cost of sales computation comprises of the following items. So cost of sales. Working number 7. Cost of sales. Normally the cost of sales will not go there. Will not be possible for you to write all the items that you want to write freely. So you may end up writing something small, cancel and indefinite. So don't do that. Kindly come and write it on its own, especially cost of sales. A lot of things goes in there. So start with the parent own. So cost of sales working, start with the parent cost of sales. Now, the parent cost of sales, in fact, happen to be the 70,500. Write the name of the parent, premium. Right, Stanford. That's actually, so Stanford, don't forget 4 out of 12 times what? Times 36,000. This should give us something like 12,000. So have you seen how we are doing it? Please, if you cannot add everything there, don't force yourself. Do a neat working. Do a separate working for the examiner. Now move on. Any other item, the intra-group sales. So intra-group sales. We said it was 4,000. Eliminate it, subtract. Intra-group sales, 4,000, subtract. Then the unrealized profit, the PUP, we calculated. Unrealized profits that we computed. The unrealized profit, in fact, we had 400. Add it to cost of sales. Again, the excess depreciation. The excess depreciation, we say we must subtract it. It is 50 from the cost of sales. Add all this together, and that should be the cost of sales figure. So if I add all, I get 78,850. So now go to cost of sales and put the answer. So let's close some of the P&L and then the P&L items. So we are going to close everything and balance it. So go to P&L. Revenue, push it there. Revenue is so straightforward. Just you are adding the 2 and lessen 4,000. So now close the revenue figure. Cost of sales, close it or put a workings. Workings number 7, then put the 78,850. Good. And then that is all. Okay. So we are done with the
78,150 or cost of sales.
Now, cost of sales should be 70,500 plus the 12,000 plus the 4,000. In fact, plus the okay, so 7,500 plus 12,000, right? That is 4,000, right? Okay, so plus 400, and then less what? Less 50. So 78,850. 78,850. So that is the answer. 7,500. Let me do it again. Plus 12,000. Minus 4,000 plus 400 minus 50. Again, 78,850. Wow.
Okay. Okay.
So can you put it in? And let's go. You're balancing off. Okay, so after balancing the cost of sales, what was the gross profit? Kali now calculate the gross profit for us. Subtract the 78,850 from the sales revenue. My sales revenue here, I'm getting 103,500. So minus 103,500. So your gross profit should be 24,650. I hope everybody get the same gross profit. We are confirming. If you don't get that, no, we will not agree. Okay, so let's go to distribution. You have it already. Distribution, my own is so minus distribution cost. My distribution cost, I had 2,900. Agreed. We asked you to push it forward. Distribution is what? 2,900. So 2,900. Okay. I hope your distribution is 2,900.
So
The gross profit.
just 22,000 plus 4.
So there is no computation apart from the one we just did here.
So the
That's
cost of
25,000.
70,850. So ignore the one on the face.
Okay, so
The distribution had 25,000.
Distribution is 2,500
Yes.
plus 1,200 by 4/12.
Okay.
That'll give us 2,900. Agreed. The distribution. Distribution should be
100.
Okay. I didn't see. I wrote a mistake.
so distribution is 2,900. We are balancing all of them. The rest is just addition and subtraction. So let's balance it well. So I write my balancing figure on the board for you. So finally, my sales revenue. Sales revenue happened to 103,500. My cost of sales, I'm getting something like 78850. My gross profit is somewhere 24,650. That's my gross profit when I do the subtraction. My distribution, I'm getting 2,900. My admin, I'm getting 6,300. So when I subtract this plus 6,300, I'm getting 15,400. When they move, you move. When they stop, you stop. So check how they calculated the finance cost and then the profit before tax. So let's go to their solution. Sorry, their financial statement. So they added the finance cost to the expense. You to do the same thing. So like the way we did. Now there's nothing to be adjusted from the finance cost. So push the finance cost to the final answer. So $100 is subtract. So at the end of the day, what's the profit before tax? Profit before tax, so minus 100. Let's go. 15,000. It should be 15,000. So let me go to the board.
15,350.
So 15,350. Then the income tax, that one, we've done it already. You just have to subtract it. You've done it already. So income tax, So income tax will be, the income tax figure we had 4,400, right? So my tax is 4,400. I need to balance everything. So plus 4,400. Wait, no. So 10,950, right? That is my profit for the year. If you don't get this, you will not understand profit for the year. Now, when you get a 10,950, then you underline it and relax for a while. Then you wrote OC, other comprehensive income, right? Okay, so the other comprehensive income. Then we now go to the revaluation. Now there's 500 there, right? Yeah. And I asked you to create a space. So right there, OCI. Let me see, friends online, if the board is clear. We are going to the latter part of the story. Okay, so my sales, sorry, this one is not coming clear. Okay, so good. So now let's come back down. Capture the downside too. So come to the other comprehensive income, OCI. Put your revaluation gain here, 500. Don't change that. Now there's a particular footnote that we read. Let's go there again. They says something very interesting. It says something here that there's a fair value gain of 300. Say previous investment includes some available for sale. It includes, so it's in there. Available for sale investments that have increased in value by 300,000 during the year. Available for sale, financial instrument, financial asset held for sale. The changes in fair value is reported in what? OCI. So this fair value gain must go to where? OCI. So first thing, 2 entries. So right here, fair value gain on available for sale asset, which is 300. Now go to the financial position and go and add this 300 to. Go to the financial position and add this 300 to. Add it to the investment. So go to the financial position, add this 300 to the investment. So the investment should be 1,800 minus a consideration of 800 plus 300. Then push it there. Good. Now let's finalize it and then balance it off and then let's move on. This is December 2010 ACCA past question. So at the end of the day, what's the total OCI? Now there's a particular transaction there. Let me explain that transaction to you and then before we end the game. There's a transaction in here. If I've touched everything except one item that I want to explain well. There's something here, this particular side. They said previous group policy is to revalue all properties to current value. That is revaluation at each year end. Fine. On 30th September 2010, the value of Stamford property was unchanged from its value at acquisition. So meaning unchanged means no fair value gain, no fair value loss, no revaluation. Fine, that's good news. That it will be a bit it requires any issue that affect the subsidiary required extraordinary workings because of the sharing. But anything that will affect the parent is so easy, straightforward. So thank God nothing, no revaluation affected the subsidiary. But they say something, but the land element of the previous property had increased in value by what? 500,000. As shown in the other comprehensive income. Good. Now it has increased by what? 500,000. Now what happened is this. Go to the financial position. See land valuation. Now the land valuation that we have here is 2,000, the financial position. Good. So it's coming from where? The land. So here, that 500 that they've informed us, it must be added to what? This 2,000. So fair value gain on the land. So that is the treatment, or basically that is how we have to treat that. So basically that is how we have to treat that. Now in the financial position, when you pick the reserves, the land reserves, it will still be 2,000 because it has been recorded. And then we add the 300 to, that's the fair value gain. Have you seen something here? We've added this 300 to this, right? Powerful. Now, any item that goes OCI must also go to equity. So go to the equity, other component of equity. What value do you have there? 500, right? Let's all of us turn to other components of equity. We had 500 there. 500. So can we add this 300 to it? So making it 800. Other components of equity. Let me project it for you to see the section before we end the game. Now, when you go to the other component of equity from the financial position, so the land must still be at 2,000. Don't change the land. The land revaluation, it has been recorded. So once they have placed the 500, it has been recorded. Don't change that one. Don't say that it has not been recorded, so let me go and record it again. No, don't do that. It has been recorded already. Once it has been captured in here, once the 500 has been captured here, then that means they perform the treatment, the other treatment. That's implied. Okay. So the other equity reserve, the 500 here, can you add the fair value gain on the investment to it and close it and push the answer the 800? Agreed. Okay, so that is all. We are done. Now, when you add these two together, you get 800. This section, most students don't like it, but please like it. This is total comprehensive income, the other comprehensive income. Now add the 800 plus the profit for the year. What do you get? That answer, let me write it here and continue from this section. I'll balance it off and go to the financial position, and then I'll provide a remix of this solution, and then you can download that if you have not done that and go through them. Now, so therefore, total comprehensive income for the year will be, okay, so the camera should go up a little. Good. So total comprehensive income will be, so putting these two together, so 10,950, let's go. 10,000 plus 800 as 11,750. 11,750. Double underlining that we are done. Now come down and come and share. Come down and come and share. Tell us, we are going to share this one individually. Share this, and come and share this. In fact, this one we don't even want to share this one. So share this and come and share this. So share them. But let me put here two. First of all, tell the examiner that profit. This section mostly don't do it. Profit attributable to owners of the parent name, Premier, and the NCI. You can only get the NCI's figures first. We are sharing this profit first. So can you bring this profit here? Record the profit, 10,950. That's what you are sharing. Underline it like this. How do you get the NCI's own? It's so straightforward. To get the NCI's value, just go to the P&L, pick the profit after tax, and find NCI's share of the profit after tax. If there's anything that will affect NCI's profit, kindly list it. That's all. Something like this excess depreciation, unrealized profit, let it off. That's all. So pick the profit after tax for that of the subsidiary. What is the profit after tax for the subsidiary? Now, profit after tax for the subsidiary is what? The profit after tax for the subsidiary for the post-acquisition period, though, not the pre-acquisition. You know, the 4-month period, during the 4-month period. That one we calculated, we had what? So I'm calculating this NCI. So workings, you can tell the exam now. Another workings. The last working was 8 or so. So 7. So this one will be 8. NCI into bracket P&L NCI, not balance sheet NCI. Okay, so over here, start by saying post-acquisition profit. We have calculated already. We had 1,300. I'm just bringing it here. Anything that will affect this profit, can you adjust it? There are only 2 items in this question here. The first item is the unrealized profit. So unrealized profit, we had 400. Kindly subtract it. When you are done, there's excess depreciation. Add back the excess depreciation to it. Excess depreciation is 50. Add the 50 to it. Now, after adding this 50 to the excess depreciation, then you now strike a deal. You now find the NCI share. So close it like this or add all. So let's go. So 1,300 plus 50 less 400. Answer 950. So this 950 can it take NCI share? So NCI share will be into brackets. So here, normally, when you are done, we just write it here like this. NCI share will be 20%. So find 20% of this figure. 20% times 950. Then you put it there. So times 2. That's 190. So come and put the 190 here. And then the good news is that the proportion attributable to the premium, that is the parent, is the balancing figure. If the total amount that we are showing is 10,950 and NCI share is 190, so the balancing figure goes to the parent. So this minus 10,950, 950 answer. So you get 10,700 and what? 60. So 10,760. We are done. Now I'm taking this side off and then we'll go and balance the balance sheet and then we are done for the day. Make sure your balance sheet balance because my it's in line and I'll copy all my own for you. Okay, so let me clear this side. Everything we have shared the profit after tax. That's the profit for the year. Please, this section of it is very important. The P&L, console P&L or console comprehensive income. Make sure that you share 2 profits. 1, share the profit after tax. That's how you share it. When you're done, if there's OCI section, then share what the total comprehensive income to in addition. Now, if there's no OCI, and then if there's no OCI, then total comprehensive income and profit for the year will be the same. So that one, just 1 pair, then you're done. If there's no OCI, imagine all these sections is 0. Then this are also good, the same as this. So there's no need for you to share it again. But where there's OCI, then that means you have to share the what? The total comprehensive income. So let's share total comprehensive income. So just write here, total comprehensive income. CI, no shortcut in exams. Attributable to owners of that again, Premier, the parent company, NCI. Here, you know the answer already. Underline it, bring the total that we are sharing. We are sharing 11,750. Okay. So over here, check whether the revaluation. Check whether the NCI had any revaluation during the year. Whether the NCI had any revaluation during the year. Whether the NCI had any revaluation during the year. Any revaluation gain. NCI never had any revaluation gain during the year. Thank God. What a good news. Because we've gone through the footnotes, the subsidiary never had any revaluation gain during the year. So the OCI here, check this OCI, it's never for the subsidiary. This is for the parent. This is also for the parent. So nothing here for the NCI. Powerful. So the good news is that here the NCI figure should be the same as 190 because he doesn't have a share in the OCI. So therefore, if I am sharing 11,750 and then your share is 190, the remaining balance goes to parents. Let's go. So 11,750 minus 190. Answer 11,560. We are done with the P&L fully. If you do this before, we will consider you and give you the full mark for P&L. By sharing, most of them don't do it. Now, let me just list my balance sheet figures. Let's balance the balance sheet. Now, every item that will go to balance sheet, you've touched it already. So I'm just going to provide a summary so that it will be the same as your own when you balance them off. So close the account. Please, let me explain something here. It's very important. I wish you get me well for this. Now, what happened is this. Anytime there's P&L and balance sheet at the same time in one question, like this particular question, Stanford. So the question is a console question where we have P&L and balance sheet. Don't say that, oh, I am carrying my profit for the year to the balance sheet. Go and compute the retained earnings there. Don't do that. Why? If there's a mistake, in your P&L, it will be translated to the balance sheet. So even though we have the profit for the year correctly calculated here, we will never say that we're going to use this one to compute the retained earnings. As usual, change in equity. Then we use the retained earnings to compute the profit for the year to compute the retained earnings closing balance, right? But here, don't do that. If there's a mistake, it will follow you. So that is why we have to compute the the book retained earnings again. Good. So let me lay the balance sheet and then let's get started. I think our time is fast. And we've exceeded our time. So this person, the balance sheet item, P&L, we are done. So let me list the balance sheet item per my what is supposed to have. We've done the workings, so I'm just bringing the items together. So you confirm as per your own, and then we are done. The entire 4 question, 20 marker question has been dealt with. And then you are fine. So first of all, I'll start by saying my PPE figure, I just read them. My assets, let me start from non-current asset. The heading has been provided already. And then you have to be, let me see the board, if it's coming clear. Okay, so let's go up a little. Okay, so that is good. So under the non-current assets, we have PPE. So my PPE, after everything, computing everything, if I should tell you what goes to the PPE, a lot of stuff, I had 38,250. How about the same thing you had? Close your PPE, let's see what you get, your PPE. Close the PPE, let's go. Goodwill. Goodwill, we had a goodwill of, our goodwill figure was 9,300. and then investment. That's all. Our investment, that one, we remember the investment. It was 1,800 minus 800 plus 300. Answer 1,300. Add all. What's the total non-current assets? Total non-current assets. I'm confirming the balancing figure so that it won't be like I've only solved the footnote and I've left the balancing on you. No. I must solve it fully and balance it and move.
48.
So the total is 48,850. 48,850. That's the total non-current asset. Good. I'll not write the name. Now let's go to current assets. Current asset 2. You open a bracket. Parent owned, subsidiaries owned. After putting everything together, we had 14,150. So 14,000 after adding everything together, I'll get 14,150. Okay, so that is that 14,150 is my current assets. At the end of the day, we added a lot of figures together. Parent owned, subsidiaries owned, and then we less the unrealized profit of 400. Again, we less what the 350 from it. So parent owned, subsidiaries owned, parent owned, subs owned, less 400, less 350, right? That gives us 14,150. What's the total assets for the period? Total assets. Let's go. 14,150 plus 48,850. Answer 63,000. Agreed.
Yeah.
Yes.
Okay, so let's go. Total asset is 63,000. Now let's go to equity quickly. Equity section, and then we are almost right. We are done. Equity. The equity shares. Now, equity shares, we are adopting the ICA Ghana section. According to the Ghana Companies Code, our shares don't have a par value or a nominal value. Any amount goes. So nothing goes to the share premium. Good. So everything to be 12,000 plus another 12,000. We had 24,000. Agreed.
Yes.
Okay, then from there we quickly recorded the land. The land was there, right? The land, they call it revaluation reserve and bracket land. 2,000. Then from there we now move on to the other component of equity. So OS, we normally call it OCE, other component of what? Equity. Other equity reserve. But they call it other equity reserve. So let's use the same name. Other than that, it will be ultra-wireless. So other equity reserve. We open a bracket and we added 500 plus what? 300. We had what? 800.
800.
Powerful. Then the retained earnings, our computation group retained earnings, right?
Yes.
We had a certain figure.
13060.
13060. Then we add all together. What's the total equity? So let's go. 24,000 plus 2,000 plus 800 plus 13,060. Answer 39,000. 860. 39,860. Agreed.
Yes.
Add NCI to it. NCI at reporting. NCI figure we had what?
3690.
3690. At the end of the day, put all of them together, or you leave it, then add the liabilities to it. You leave it and add your liabilities to it. Or you can add them. Okay, let's add them and get the total equity. So 39,860 plus
43,500.
90. 43,550, right?
Yes.
Then that's the total equity. Then let's go to non-current liability. The non-current liability too, in fact, copy everything. There's nothing new there. So 8% loan note, right? 6% loan note. For this side, what's this one? So 6% loan note. We have 3,000 there. Okay, so that one is what? 3,000. What's the non-current liability? Sorry, the current liability. You open the brackets, you added the parent own plus the subsidiaries own, less what? The intra-group debt of 350. Agreed?
Yes.
Good. When you do this, you get what? For 16,000.
450.
16,000.
450.
450. Now add all equity plus non-current liability. So equity plus all the liability. So total equity and liabilities. Let's add all.
This is 3,000.
When you add all, what do you get?
This is 3,000.
3,000. So that's the balancing figure, which is the same as the total assets for the question. So this is the full solution of it. We have provided the notes, workings, and everything. So kindly go through them, and then you will be fine. This is exactly December, ACCA December 2010 paper. It's about 11 years ago. It's older than someone. About 11 years ago question. It still look good. It still look fine. It still look fantastic. It still look powerful. So that is the end of the game. So we'll end here. If you don't have the material, I can request for you to give you the material, and then we also walk you through everything. Please subscribe if you have not done that. And also tell a friend to tell another friend to watch some of our videos. Okay, so end here. I'll see you when I see you in the next meeting.